In this video, I'm going to go over my own process of how I find undervalued growth companies or growth stocks, where I basically search for stocks, particularly in the USA, who are growing their top line revenues quarter after quarter, year after year, and reinvesting all of their free cash flow back into the business to basically create new products, expand new product lines, expand the team, and also expand their operations potentially geographically as well. Let's dive into the process. So the very first thing that you want to do if you want to find promising growth companies or growth stocks is to go to finviz.com. It is a 100% free stock screener that can serve as the base of your at least preliminary or initial stock market research. So what you're going to do is you're going to go over to the screener, and then you're going to basically go to the fundamentals section. And from here, you're going to look at sales growth past 5 years, and you can probably or sales growth quarter on quarter. Either way, you can use either or. Some of the new growth companies, of course, will not be listed 5 years ago, and so there might not be enough data here. But let's say sales growth quarter on quarter, and we're putting this at over 10%. So out of the 9,000 names that have just appeared, now it is 1,973 names. If we are looking at growth companies specifically, these are probably mainly tech companies or software as a service companies, any type of company that basically is reinvesting at a very fast rate to get their revenues up. And so what we'll be looking at this stage is they probably don't have any net income or net profitability yet, because all they're doing is reinvesting back into the business, or they might be issuing debt or new shares to basically reinvest their growth back into the business. So return on assets probably will be negative. Return on equity probably will be negative. Return on investment also will be negative. Operating margin might also be negative. Net profit margin might also be negative. So what we are going to do in this case, and also PE might be negative, because a lot of these growth companies, sure, there are growth companies who are profitable, like Apple, for example, like Microsoft, but they don't grow as fast, and they're not growing probably their revenues at a very, very fast clip of 10% per quarter. So if we're going to find growth companies specifically that are reinvesting at a very high rate of return, who are sacrificing profitability in the short run, then we can take a look at gross margin. And so gross margin is basically sales minus cost of goods sold, and that produces the gross income. And so what we want to look for is we want to look for companies who have very little cost of goods sold, or COGS, compared to the revenue. That will produce a very high gross profit margin, which could be an indicator of product market fit. And so what we want to do is we want to actually raise this to, let's say, 50%. And so now, out of the 9,000 or so equity names we had in the beginning, this is now shortened to 500 names. And so there's a lot of companies here. A lot of them will be garbage. A lot of them will be unprofitable. A lot of them will be, let's say, not the best candidates. So what we can do is we can filter either through industry, and we can filter either through market cap. So let's take a look at market cap, going to largest and smallest first. So we're filtering from largest to smallest, because if we just look at the smallest ones first, a lot of them are kind of really, really bad type of companies. They issue shares all the time. They're not doing anything. They're pumping up their stock price. Who knows what? They're doing a lot of interesting, weird, gimmicky stuff that, in my experience, has led to a lot of short sellers, or a lot of people betting on the decline of the company, especially for those nano cap, micro cap type of companies. And so we really want to take a look at companies in this level here. And so, for example, this is a great playing field now, because we have the largest cap companies first, and we can pick some names we're familiar with as part of our shortlist. And so if I move myself over here, you're able to see that there's Microsoft, there's Google, there's NVIDIA, there's Meta, there's Visa, MasterCard, Adobe, Salesforce, McDonald's. So I would probably look for companies that are probably not in the biggest category. Of course, we all know that companies like Google, Microsoft, and Meta, they all have some sort of competitive advantage or moat around their business, which allows them to earn high gross profit margins and high net margins, high free cash flow margins over a long period of time. However, let's take a look at companies that are, let's say, still high cap, big cap companies, but potentially not as big as, the Apples or the Microsofts of the world. And so we're looking at, let's say, Airbnb is one, KKR at Moody's, for example. These are all great companies. Monster Beverage Group, MSCI. And now we're looking basically, so now that we've shortlisted down, I remember I said that return on assets, return on equity could be negative. I'm not saying this for all companies. I'm just saying let's not exclude companies who potentially are profitable as well, but let's also include companies that are not profitable too, that are reinvesting back into the business. And so we can pick companies that potentially you are familiar with, who have a competitive advantage and who are also growing at a fast clip. So just based on my experience, I think companies like MSCI, they basically are in the financial data exchanges industry. They have a competitive advantage, like they have a moat around their type of business model. And of course, they grow as the number of market participants grows, the number of basically financial companies grow. And so if I just click on this, then we can basically look at a price history over a long period of time. Even looking at the price history from, let's say, 2012 all the way till now, sure, obviously there has been some growth happening that has obviously risen. The stock price has risen in tandem with this growth. Of course, we'll have to do a lot more research, but this is the preliminary start of the research. And a graph like that, usually, I'm not saying in all cases, but in a lot of cases, if a graph like that looks like that over 10, 20 years, there's a high chance that that company has abnormal rates of return, has abnormal rates of return on equities, and potentially abnormal profit margins, which lead to obviously a moat or indicates one, and they can reinvest their profits at a better rate as well to help grow or further grow the business because there is product or service market fit. So if we continue down, we can see companies that potentially have higher growth potential. Trade desks I've seen over the years, obviously HubSpot, but these guys have been pumped up because of the 2020 COVID issue, and obviously have crashed as a result and are only now going back up. And so let's take a look at other names here. These ones I'm not too familiar with. I know Pinterest and Trip, but that's a Chinese company. Chinese companies are always a bit difficult because of the valuation. It does not always reflect the true fundamentals, and tends to be a lack of value discovery in Chinese names because of data discrepancies and a whole lot of other political things that I won't get into in this video. But it's just quite difficult to invest in Chinese companies, in my opinion, compared to US ones because of that value discovery issue. Let's see here. Software, XP, Insulet. I know of Okta. I don't really understand their business model though. Affirm, I know that one. But also a lot of these companies have been pumped up during COVID and then crashed as a result when interest rates increased. So you really want to stick to basically names that you really understand. I tend to stick to the larger cap ones like Apple, like Microsoft, the ones that actually have a proven track record of growth and free cash flow growth, net margin growth, and red sales growth. But I might take a look at other companies here that potentially might be reinvesting at a really high rate of return, but probably are still not yet profitable because they're sacrificing profitability for basically higher revenues, immediate revenues right now compared to profits right now. So Wix I might take a look at because they're a web platform, and because I'm familiar with websites and marketing, Squarespace and all of these things, and WordPress, I know Wix is doing a really good job from a UX UI design perspective. So I might look at Wix and understand a bit more about how they're growing their business. So as you can see, of course, from the price, 2021 crashed when rates increased, and now there's some value discovery going back in. So they're still trading at a 4P of 26, which is probably not too bad given where it was in the previous years where it was clearly in bubble territory. So let's see what else we got here. I don't know any of these ones. Maybe you guys do. I know AppFolio, but I'm not too familiar with their business model. Let's see. Any of these ones? Not so much. Abercrombie Finch out of Void Apparel Retail. Very cyclical business. Freedom Holdings actually held this in 2020, 2021. They're a brokerage in Eastern Europe. They've grown significantly over the years, but of course they're not a U.S. company. They do a lot of trading in Eastern Europe for their business. But in terms of speculative growth, that is something you can look at because there's a lot of other people who want to get into retail trading, especially in that part of the world. So that is something I'll probably be looking at, but more of a high risk play. WD-40, love that company. It was really highly valued at some point because of COVID. It has kind of tampered down over the months like last year, but now it's really risen a lot. So you can see here, WD-40, a very good, stable company. Not necessarily a growth company per se, but very stable. And then COVID really pumped it up, crashed like a year and a half ago, and then now kind of retracing back up. But it's still, in my opinion, still relatively highly valued, high PE ratio for that one. So some REITs here, not necessarily considered growth companies, they're just real estate investment trusts. A lot of REITs have been beaten down over the year because of the interest rate hikes. So I'll just go through them and really understand. I think you really have to understand that each investor is different. What I understand, what my circle of competence is different from your circle of competence. And so you just want to go through the industries and the companies that you feel like you understand, who are growing their revenues over time, who potentially are, let's say, net margin positive or ROE positive, return on equity positive. Does not necessarily have to be that way if you want to basically have a company or find companies that are reinvesting everything into the growth of the business, sacrificing profitability like Amazon has done for many years. So that's why I only put gross margin over 50 and sales quarter over 10. You can adjust this to 5 if you want, or 10, or make it more depending on how basically you think, or how fast you want your companies potentially to be growing. But I like to do over 10 because it does capture companies like Apple, like Microsoft, who are already profitable and are still growing at a relatively fast rate of revenue. If I were to say anything, and this is not financial advice per se, but I would say, in my humble opinion, I do feel that investing in growth companies that are already producing some form of net income, at least there is a valuation floor or base range. So, for example, if we're trading at a PE of 5 to 15, it gives you a decent range, which could be considered relatively fair value. However, if you have a growth company that is reinvesting everything back into the business, there is no such thing as price to earnings because earnings are negative. You'll have to use metrics like price to sales ratio. So it's reflecting the valuation of the company compared to the revenue it generates. And price to sales ratio can vary significantly, but it does not give you a good indication of the future profitability of the business and what the business could be valued at. So, for example, businesses like Zoom, in the height of the pandemic, were trading at extremely high price to sales ratios. So let me show you what Zoom was trading at. So here we are on koifin.com. This is free software I like to use. You can get an account and register. They have a paid plan, but I use the free one currently, and there's a lot of data available to you. And this is Zoom's price to sales ratio in the height of the pandemic. If I move my screen, it was at 115x their sales and has now crashed all the way to 4. So obviously revenue has gone up during that time, but it just shows that if you're investing in a growth company and they don't have any net income, so there's no price to earnings, there's no kind of relative valuation you can value it apart from price to sales and a few other revenue metrics, it is hard to say what is considered fair value. Is 58 times sales considered fair value, or 114 times sales considered fair value? These ranges are what would be called ridiculous, but people were buying and selling Zoom during this time because of the COVID frenzy. And so obviously that has tapered down, and rational investors have come back to planet Earth. So that's the only drawback of investing in growth companies, which you have to be aware of. You have to understand that if they're not producing any net income and they're only got price to sales ratios, or you're really valuing the company based on the future revenue projection, and you have basically only sales ratios to deal with, like relative valuation, it's called relative valuation, then these can be pretty inaccurate at times, especially when there's a big bull market going on. So it's just something to keep aware of while you're searching and filtering for growth companies. You want to be able to invest in growth companies where there are basically revenues being generated, but they're trading at a relatively, I would say, reasonable price to sales ratio, where if you forecast 5 years out, you're able to see, okay, the price to sales ratio goes down by basically 1x or 2 times sales, and maybe that would be considered fair value. You have to do your own research, you have to check, you have to analyze the companies. But going on Finviz is a great way to get started, and then you can use koifin.com to basically do more due diligence and look at ratios, valuations, etc., and read reports. Thanks much, guys, for watching. I really hope you've enjoyed this video. If you did, please give it a like and subscribe. I'm doing my best to create daily DIY investing videos for you only, so I really hope that you get a lot of value out of it. Looking forward to chatting to you soon. Take care.